Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Chevron Corporation, ticker CVX. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. Let's dive on in. First, with market cap. This is a $278 billion market cap, $295 billion enterprise value. You can see some leverage there. They have about $17 billion in net debt. This operates in the oil, gas, and consumable fuels industry. This is basically an oil company, energy company. They produce oil and natural gas. You can see that they engage in integrated energy and chemical operations worldwide. Two segments, upstream and downstream. Upstream is the oil segment and downstream is the chemical segment. I actually know quite a bit about this company, looked at it before. So it's not a complete first look at this company, but it is one that I'm really interested to get into. Now, one thing that you'll see here is that they have a lot of years of profitability, except for some recent times. They lost money in 2016 and 2020. That's losing money 2 years out of the last 20, which is a little high for me. My threshold for a high quality company is 19 or 20 years of straight profitability. 2 years of losses makes them at 18 out of 20, which is still pretty good, but it's more on closer to the average side than the high quality side. The other thing you can see is just the pattern of this return on invested capital shows that it's a cyclical company. You're going up and then down, up and then down, up and then down. You can see the waves in the returns. And that's going to be driven by the fact that oil is a commodity. They don't really have pricing power. They can't set the prices for their material. So that cyclical nature of this suggests it's both a lower quality company as well. Now, what we're going to see is that they are spiking in the return on invested capital in 2021. And of course, in 2022, recently, they have been having very good performance due to the high oil prices. And that's generally what you're going to see here. You had high oil prices in this 2008 timeframe, 26% return on invested capital, but it's been downhill since then. In 2011, you had 21%. Had some high oil prices, 2018, 7%. But of course, these bottoms in 2020 are showing you that the oil prices and the oil performance have gotten worse and worse over time. Now, could this be changing in the future? Could you get back up to these type numbers? Absolutely. But this is never going to be a super predictable business over the long term, and you can clearly see that with that 20-year history. And these 10-year median returns are just simply too low for me to be interested if I thought they would be repeated. So the only way I'd be interested is if I thought this was the more thing to expect in the future, kind of an energy shortage, 20%, 21%, 22%. Those are amazing numbers, but 8%, 6.3% is not very good. PE ratio of 13.6. It's very hard to address the PE ratio of a company like this because you look at the earnings per share numbers here, you're going to see that they jump around a lot. So we have $8.14 per share in 2021, but you lost money in 2022, $1.54 in 2019. And that 8.14 is really the peak since 2014. So you've had 6 other years with much lower numbers. You had a decent number in 2018, but you have to be very careful because this earnings per share growth rate is all over the place. So just something to be aware of, that this PE ratio on the surface looks very attractive. Anything under 15 is both very attractive. The problem is you have to be careful that you're not extrapolating a peak earnings number with a high valuation ratio in this industry, especially because these sorts of companies carry a lot of debt. All these numbers here for the 10-year CAGR look terrible, dropping 4% per year in revenue while you're growing assets. That's not what you want to see, and it's not. And you can clearly see here in 2020 you had a revenue of $230 billion. Now you have revenue of $155 billion. Those are just, but all that's telling you is what we can see clearly on this chart, that you've gotten worse and worse across the decade. If you're enjoying this video so far, please hit that like button and don't forget to subscribe. Your subscriptions help to grow the channel. Your likes help to tell the YouTube algorithm that you're enjoying this content and they should recommend it to others. So please like my content if you're enjoying it. Now, on the income statement, let's see what else we can see. You do see positive gross profit every year, but what you don't see is positive operating profit. Sometimes you have companies that have a loss on the net income line, but they keep 10 straight years of positive operating profit, and you don't see that here. You do see negative operating profit in 1, 2, 3 years out of the last 10. That's simply too high. I mean, and if you could add 4 if you include 2019, where they had a really close and narrow positive gain here. So something to be aware of. Just a lot of losses for a company like this, and so it just makes it very hard to predict. Now, you can see that they have bought back shares consistently over most of the last decade, and then they had to issue some shares in 2020 likely due to the pandemic, likely due to the massive drop in oil prices, just something to be aware of. But overall, their capital allocation has been fine. But you do see that their EPS is still lower than it was a decade ago. And again, that's that cyclicality of the company, a big sign of it being an average business. One thing to see here as well, you can see just the cost of goods sold plays a big part in this, but you have very large other operating expenses. So there's a lot that they have to support on this business model. Let's go to balance sheet. It should show you pretty well. You see they're carrying a lot of assets. You got $122 billion in assets. You end the decade with $146 billion in assets. So they have a higher asset base than they did a decade ago, but they have lower operating profit. That's not a good setup for you to have in the long term. Likewise, the debt has tripled from $10 billion to $30 billion. Just a lot of debt to carry on a business like this. Cash flow. Now, cash flow is where you get kind of interesting. So despite having those negative net income in years, you had positive cash flow from operations every single year. So that looks better than the net income line. Why? The difference? You have very large depreciation. This is very common for the oil and extraction industries. You have large depreciation amortization numbers, and it requires some expertise to determine, is this real? You do see a constant investment in PP&E. This is drilling, this is new plants, everything like that. That these large investments are sometimes even higher than your cash flow from operations. You're having to pay it with debt. It's a very complex business to assess. This is not a sort of business I would recommend for a beginner to assess. You kind of have to be somewhat understanding of the industry because there's a lot of moving parts with common stock, debt issuance, dividends, financing, PP&E. This is also, again, kind of what you'd see with an average company. There's no clear one picture I can easily draw out from it, and that lack of a clear picture is what would have me sitting on the sideline and not investing. These are the type of companies that they're very strong, they're very stable, they're not going to go bankrupt, they have a long history, they're very well managed. It just doesn't guarantee you a high return. All of the major oil companies, whether it be Chevron, Exxon, Shell, they have a long history of paying out dividends, long history of doing very well, but they're just very unpredictable, and you can clearly see that in that chart. If you enjoyed this video, please hit that like button. Don't forget to subscribe. Your subscriptions mean a lot. It's a great way for you to support the channel. I'm really striving to hit that 2,000 subscriber mark in the short term, and I need your subscriptions to do it. Thank you for listening, and until the next time, stop paying fees, start building wealth.